Well, good evening, everybody. I want to go ahead and welcome you to our Tuesday night webinar series. My name is Dave Aquino, and I am the Options Live Trading Specialist here at Microquant. I run the Options Live Trading Room, and I'm happy to see a lot of the people from my room are with us tonight. Okay, so I appreciate that. So tonight's topic of tonight's webinar is a new topic that I'm exploring. First time I've done this presentation, and it's basically trading the opening hour with options in the Options Live Trading Room. Now, if you think of any questions during my presentation, please go ahead and submit it via the GoToWebinar side menu. You'll see the questions box, and then it'll pop up on my screen. Now, I'll try to answer the questions as you submit them, as long as they're pertinent to the exact topic that I'm talking to at that time. If it's a question of maybe a previous section, I'll come to it at the end of the presentation in the question and answer segment. I'll try to make sure that all questions are addressed before we leave this evening. Okay? Hi, everybody. It's nice seeing everybody's name from the Options Live Trading Room. Had a lot of people in there this week, and everybody's saying good evening. Good evening, everybody. And again, I just want to personally say thank you to everybody for taking the time to come and visit us. So we'll just go ahead and continue here. I think we've given everybody a good amount of time to go ahead and sign in. Okay, the risk disclaimer. We at Microquant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Now, this content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content, or from an inability to access such information, or any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. CFTC Rule 4.41. This is a U.S. government required disclaimer. The CFTC wants you to know that futures and options trading not only has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with money you cannot afford to lose. This is neither a solicitation nor an offer to buy, sell futures, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on either of these two disclaimers, please feel free to contact us at Microquant. Thanks, Ronald. I appreciate that. There we go. That's the CFTC Rule 4.41, and here is our risk disclaimer. Okay, so thank you very much for working through those disclaimers with me, and let's go ahead and get to the topic of tonight's webinar: trading the opening hour with options. Now, the essence of tonight's webinar boils down to two questions. Why would you want to trade the opening, and how do you do it? Can I go ahead and ask you to give it a try? Can you respond in the questions box? Why do you think, in your experience, should you trade the opening hour of the market? It seems like it was an interesting topic to you, and you signed up for the class. What do you think? What do you think about when you think about that question? Why would you want to trade the opening hour? Okay. I see lots of volatility, price movement, momentum is high. It's more volatile, highest volume of the session. Good. Excellent. Bobby, it seems like other people can hear me. You may want to adjust it. Maybe it's your headset. You want to check your plug-in. That might be good. Okay. If at any time, this looks like I may be experiencing some difficulties. If at any time you guys can't hear me, or if my sound cuts out, can you please quick throw a question up there and just say, Dave, I can't hear you? Because I'm getting some notification from GoToWebinar that it may have a little bit of trouble here. Okay, great. Thanks, Rolando. Just want to make sure. Okay, so those are all good answers. Volatility, volume, momentum, very good description of the opening hour. Okay, so let's just keep going. Okay, now I'm an amateur scuba diver. Actually, I'm a dive master. I was an assistant dive trainer when I was in college, and I love this picture. This is how amateurs probably view the market. Beautiful, wide open, full of potential and opportunity. Now here's probably what's waiting for them. Okay? Enough said. Welcome to the wild world of the markets. Okay? Most people see this. Those that know usually look out for this. Okay? We have a saying on Wall Street. Amateurs open the markets. Professionals close them. Now, have you ever just taken a look at a normal daily bar chart and take a look at the open and take a look at the close? Most of the time, they're at opposite ends of the bar. Okay, so right here, this is Google. It's a daily. Look what happened after it gapped up. Here's the open. Here's the close. Here's the open. Here's the close. Now this one's unique. The open is here. The close is here. They're very close together. Actually, we have a candlestick known for that. That's called the doji. Okay? Usually it's a point of indecision. But when the markets decide which way they want to go, this is the open. This is the close. Open, close, open, close. And here's today. Open, closed. They're at opposite sides of the market. So it leads you to believe that, okay, well, somebody knows something and there's another group that doesn't. So which group do you want to be in? Okay. So basically, the opening of the market can provide a clear view in the imbalance in buy and sell orders. Okay? If you think about it, everybody that reads the newspaper, reads Barron's on Saturday and Sunday, they sit there, they go, oh, Apple's a good buy, or Google's a good buy, or Tesla is doing great, so I want to put my buy order. So they go to work, so they put their buy orders with their broker the night before. So 9:30 Monday morning, the market maker's about to open up the market, and they see that they have 100,000 buy orders versus 25,000 sell orders. So there's an imbalance there. So what the market makers will actually do, if there are more buy orders, they're going to open the prices higher. Okay? Because you're supposed to, as an investor, want to buy low, sell high. Well, market makers basically going to sell high first because there's plenty of buy orders. Okay? And conversely, if there is a bad article in the newspaper and people decide they need to sell something, if there are more sell orders, they're going to open prices lower. Okay? So when the market opens, there's a gap. Now, when these imbalances correct, usually prices move back towards the gap. and market makers can balance their accounts and profit when the gaps fill. Okay. I'm sorry, Bernard, you may want to check your connection. Sounds like a lot of people can still hear me. So just double check that. If for some reason that a lot more people can't hear me, I'm sure you'll let me know. Okay, thank you. So basically when the imbalance is correct right after the open, that usually prices move back to fill the gap, market makers can balance out their accounts, and then they basically make a profit there. So that's when the gaps fill. Most institutions are aware of this, so they won't actually put their own buy or sell orders until the gap is filled. Okay, so they wait before entering new orders. So basically the smart money waits until the amateurs are eaten first. And right here, if you've ever seen this, this is a mackerel bait ball. And dolphins, sharks, and tuna basically herd all the little bait fish into this ball, and it just sits there and spins around and around, and the big predators come in, take a bite, take a fish till all the fish are gone. That's basically what the open looks like. This is how professionals see the open. It's an opportunity to take advantage of the smaller fish. That's basically what it is. So how do we as individual traders take advantage of the open? Okay, and now I'll tease you a little bit here. I'm going to show you what the trades are that we're going to do, and then I'll go over a couple of things about our indicators, and then we'll go ahead and show the trades. Okay, but basically the first type of trade we're going to do, we're going to fade the opening move. Okay, the market gaps up, and we'll fade that very first opening move. Now after that opening move happens, then we'll usually look for an opening gap fill. Let me give you a picture of what this looks like. Here's the market. Here's the close previous day. Let's say we gap up. So we gap up here the next day. Okay? This is the close. This is the open. There's a gap right here between the two. So sometimes what we'll do when we see the opening move, the opening move will be higher. It'll gap up and it'll move higher. And then what we do is we fade this move right here. Okay, we go short right here and prices drop. And then the next thing that we can do is prices go up and then they fill the gap. Okay, not only do they go up and then we fade that little move, but we hold on and we fill the gap. Now sometimes we don't get quite something this dramatic. Sometimes we get this, it moves up, and then it moves down a little bit, then we move higher, and then we fall. We'll short right here. And basically that is a divergence, and then we'll fade that. Okay? So those are the three types of move right there. Well, and we can talk about this because there's different types of gap fill. That's correct. Naga, you made a comment. There's no guarantee that a gap will be filled the same day. That's correct. But what we're doing is a lot shorter term than worrying about the entire gap fill. And you'll see. Okay? And divergences, the question is, can you explain divergences? I'll go into that in a little bit, Sid. I need a chart to show you that. But just to kind of give you a snapshot, this is what we're going to be looking at. Okay? All right. Let's quickly touch base on these different aspects of technical analysis. It's kind of what we're about here at MicroQuant. And in order to better understand the charts, I kind of have to touch base on this so you have a little bit of a background. I'm not trying to teach you everything at one time, but I'm trying to give you enough information so you'll be able to follow as to what I'm doing. Okay? Still, feel free to ask questions if I need a little bit more clarification. But you guys have probably seen this before. Understand what the term technical analysis is. It's a way of looking at the markets in which we are looking, and most of the time it's price. We have a price chart. I see price go up, price go down. I see price go up slowly or down quickly. It's all based on, the change in the value of the stock. But we also have two other components of technical analysis. You've maybe seen momentum in the past, but the term value in the way we use it at Microquant may be new to you. So I will go ahead and explain this a little bit more. Now, price, it's pretty simple. You guys see it all the time in the price charts. The daily price chart, it's right there. Traditionally, we use open, high, low, closed bar charts. Okay? Then for momentum, you may be familiar with the MACD. Okay? But here with value charts, we actually use our momentum indicators, and the main one that I use is MQ momentum. I'll show you what that is. Now, recently I've been using this momentum indicator. It's known in TradeStation as BB squeeze, but Trade the Markets has a version of this. It's their squeeze indicator. And I use it in conjunction with MQ momentum, kind of to have an extra momentum indicator in there that can verify as a filter what I'm reading in MQ momentum. Then we have value. Now, this is a little different than what you may be used to, but the value aspect of technical analysis is measured by our value charts indicator and by extension value bars. Okay, I'll go into that more in a little bit. And then for specific trend identification, we use our MQ regression indicator and MQ trend indicator. Now I'm going to go into and show you exactly what this means here. Okay, just for you guys that already know the indicator settings that we use for these, value charts, value bars, there's a 5-bar analysis period. MQ regression, I extend that to a 100-bar analysis period. And then MQ momentum and BB squeeze, I think this is the only thing that's adjusted, this 20, but this is the default setting. Now, I trade specifically on tick charts for the opening, and each of them is calibrated for each of the trading securities that I use. And you'll see. It is to the best of my understanding, Naga. Okay, this is our value charts indicator. Now, traditionally, when you hear value in terms of financial planning and things like that, you're usually hearing about value mutual fund. Prices are undervalued in this stock. You should buy it. What we mean by value chart with value charts, our definition of value is an objective evaluation, not subjective like an analyst is saying he thinks it's undervalued, but is subjective. It is the current price of a stock based on the real past prices within an analysis period. So we are actually comparing the price right here with all the past prices within the analysis period and saying, where does that price lie in relation to all these other prices? Is it less or more than this average price in this analysis period? Now, what you have with value charts is we basically plot the current price within five primary valuation zones. You see this green fair value zone. Prices are in this zone roughly 66% of the time. Okay? Now, that is fair value. That is the reasonable level of value for 66% of stocks prices in a given time. Now, we have this yellow valuation zone above and below the green fair value zone, and prices are in these zones roughly 16% of the time. Okay, and then above and below moderately and overvalued and moderately undervalued levels, we have these red extreme valuation zones. This is extremely significantly overvalued here, and we have significantly undervalued down here. Okay, now prices are in the red, significantly over and undervalued zone roughly 1 to 2.5% of the time combined. Now you can see that the majority of the time prices stay within the green fair valuation zone, but every once in a while hit moderately and significantly over and undervalued. Now, these are our traditional open, high, low, close bars. I really don't want to get much into it, but basically here's the open, here's the close, here's the high, here's the low, and here's the body of the bar. Okay? They've been used that way for 100 years or more, and it gives a good idea of price over time. Now, here is the open, high, low, close bars with value charts. So not only can you see how price is moving over time, but you know this, when prices are up here, they are in the red, significantly overvalued zone. Okay, that means there's a tendency for prices that are at that extreme to actually pull back into the green, towards the yellow and the green valuation zones. And you can see that these prices in this area are in green fair value. Prices up here, moderately overvalued. Prices down here, moderately undervalued. And here, prices are significantly undervalued. Okay? So basically, you see both, here's the price and here's value, but when we're watching these charts in real time, especially maybe on tick charts, it's hard to look at two different chart setups at the same time. And that's why we created value bars. Basically, this is the same standard open, high, low, close bar chart, but we've actually put the value level indicators on the bars themselves. So you know when prices are, give you an example here, they are green and in fair value. As prices continue to fall, they enter the yellow, moderately undervalued zone. And if they continue to fall down here, they're in the red, significantly undervalued zone. Okay? So right there, you can see both price and value at the same time. Okay, so that right there, that was our value indicator, our value charts and value bars. What I'm showing you here is our MQ regression and MQ trend indicators. Again, they're primarily used for identifying the trend of prices over a specific number of bars. And in this case, you see this red bar, this red line sneaking along here. When it's red, this is MQ regression. When it's red, it's showing that prices are in a downtrend. When it is green, prices are in an uptrend. Okay? Now MQ trend is usually used to identify the trend also. When the dots are red, then prices are also considered to be in a downtrend. We use them sometimes as trend following indicators that both MQ regression and MQ trend are both red. It's okay to take positions that are short. If both the MQ trend and MQ regression are green, it's okay to take positions long. If they're in disagreement, you may want to stand aside. Okay, but basically that is how they're used in our trading. Now, I also use MQ trend in a different sort of way. I'll go through that also. As you see, prices are going up. If this move up right here, it hits the MQ trend dots. In a way, it provides a level of resistance, and usually I use them as target points. If I'm in this position and I'm long, I know it's going to have a little difficulty pushing through these MQ trend dots. I'll take some profits here. Okay? It's another way I use it. So next is MQ momentum. This is the MQ momentum indicator here. Basically what MQ momentum is the momentum of price movements. It's basically seeking to gauge the momentum of a market as prices move down and up. Now when prices are, the momentum indicator is basically comprised of a fast solid line and a dotted slow line. Now when the fast line is below the slow line, the MQ momentum histogram is negative in red. When the fast line crosses the slow line, we get a transition from red to green. Now when momentum is positive, bullish, and the MQ momentum indicator line is above the slow line, we get a bullish momentum that usually pushes prices higher. So it's very similar to an MACD. That's right, Joe. But actually, we basically took parts of the MACD indicator, created a hybrid that kept the most important momentum factors together. This is one of the major indicators that I use in my trading. Okay, so basically all you need to remember is when momentum is down, usually the histogram bars are red. When momentum is up and bullish, it is positive and green. Another thing too, when prices usually follow the indicator line, when the slope of the indicator line is negative, then prices are falling. When the slope of the indicator line goes to 0 or goes flat, that's an inflection point. I'm looking for momentum to change and go in the opposite direction. So momentum goes down, goes flat, now goes up. When it comes to this point here, momentum also goes flat and it changes direction. So do the prices. Okay? Something that's very useful in our intraday trading. Sid, TOS has the value charts for TOS has the MQ momentum indicator in there, in that bundle. Okay, so again, to touch base again, for our opening moves, our opening hour, the trades that we normally look for, we look to fade the opening move, we look for a potential gap fill, okay, and then we look for divergences on the second or third moves in the same direction of the opening move. And don't worry, I'll go into this and show you, okay? All right, ooh, I'm sorry. All right. So any questions so far with the momentum, with the indicators? Okay, we'll go ahead and keep going then. All right. So basically, what are the components of our opening trades? Basically, we trade options on individual securities, options on stocks. For our opening trades, our time frame is very compressed. We try to buy and sell fairly rapidly. And in order to do that with options, we don't really mess around with spreads. Okay? We are, excuse me, very direct. We buy directional calls and puts. Okay? Excuse me, one moment. Okay, specifically, we utilize in the money weekly options. Okay? Specifically, which calls and puts do we buy? This question comes up a lot for people that are new in the options room. Which calls, which strike prices do you buy and sell? It doesn't matter. What we look for is an in the money put and call with a delta of 70. It can be delta 68, it can be delta 85, it doesn't matter. As long as you're utilizing in the money calls or puts that have a delta approximately 70. Okay? And the trades are basically this. If we gap up, gap down, okay, here's the close. We gap down, here's the open. We look to buy calls because we look for prices to go up. If this is the close and this is the open, we gap up, we actually buy puts because we expect the stock to fall. Okay? It's very simple. Now, why do we use options? Well, very simple reason. There's a lot of leverage here. Okay, a lot of leverage. Now, which stocks do we trade on? Now, most of the time when people say, I'm going to look for a gap to fill, usually they're talking about indices. And I completely understand that the Dow, the S&P, the NASDAQ, those are the three, sometimes the Russell 2000. I've tried to trade the indices, and it follows all the same rules we've been talking about here. The problem is it usually doesn't move enough in terms to change the value of the options considerably. Sometimes another factor is when we trade the options on the ETFs, those options are so cheap. We're talking about weekly options that run anywhere from $1 to $2. In order to get any considerable change and profits out of that, you may have to buy 10 times the amount of options in order to get the same equivalent type of return on an Apple option. Okay? And that's what's going to get you there is actually the commissions, because they don't ask how much the stock is. They just charge you by option contract, and it will really eat into your profits. So this is the way we do it in the options room. Okay, we use which stocks? The ones with high options volume and liquidity. Also, there needs to be high options trading volume. Okay. Also, it always helps to have big dollar stock prices. We're talking about Apple at 500, Google at 1,000, Priceline at 1,000. That always helps. And then we want large daily average true range moves. It's great if it's hard to give it. Goldman Sachs, its average true range might be $3 or $4, but I'd much rather trade Google, whose average true range is maybe $15 to $20. Okay, and you'll see why. Okay, so now I can so you kind of understand. This is what we trade in the options room: Apple, Google, Amazon, Tesla, Priceline, Netflix, and CMG. Naga, it did for me. Sure, I'll go into that, Rolando, also. Okay, so the ones I've underlined are the ones I primarily like to trade. Okay, so best way to show you is through example. All right, here's the first type of trade. We're fading the opening move. Now, this is a little harder to see. Again, you have to keep in mind the value, but I'll try to explain it as best I can. Sometimes it's easier to see actually trading. But Amazon closes up here. We gap down. Okay, all the way down to here. Now, immediately upon the open, Amazon begins to move up. Okay, now most people will say, well, Dave, the gap is from here to here. Trade didn't work. It didn't fill. That's not what I'm always after. Okay, see how we're significantly undervalued here? It's red. We move back into the green fair value zone here. And then we hit the opposite value level. We hit a yellow overvalued. That, if you're fast enough, can constitute a fading the opening move. It doesn't mean it's going to move all the way and close the gap. Sometimes this is all you get. Now, sometimes you need to watch the momentum, and it will help give you clues as to when to get out. But this is basically fading the opening move. I would say this is probably the least successful, if I can put it that way, mainly because most of the time you see this move just like here, and you can't get in because it's already moved to fill the gap. It happens so quickly. Again, this is Amazon. Notice this is a 75 tick bar chart. Okay. So let's move on to the next trade. The way that this move usually works better, and actually I hadn't seen one in a while, when this thing opens, you'll usually get one bar and another bar and another bar. Usually there's a support and resistance level like this. Another bar, and then it breaks. Okay? It's not like this immediate move. But basically you're fading the gap. That's this opening move. Okay? Next is a gap fill trade. This is very similar to what I just showed you. It does move to fill the gap a little bit, it pulls back, and then it actually completely fills the gap and it continues to run. Right there, here's the gap, here's the close, here's the open, and it fills the gap. Okay, and it gives you more. Lots of times you'll see a trade like this, and I like to trade this. So Google actually gaps down. All right, so this is a minus trade. You know, maybe it gaps down minus 6 points. I like to see this kind of trade when the market is up. If in pre-market indicators, if the NASDAQ is up like plus 7, okay, so the market is up, Google's gapping down. I like to be able to fill the gap in the same direction that the market is going. It's harder if the market is down and we gap down, and now we hope that Google will move in the direction counter what the market's doing. Okay, so again, this is a gap fill trade, and this does fill the gap, and there's more. Okay, and it can happen in both directions. And then last but not least, this is what we probably get about half the time. Here we don't get a true gap fill. I mean, we don't really get a true gap. It closes here, it opens here, and the bar immediately fills and it starts to move. There's almost no difference. There's almost no gap. But what we do is we do have an opening move down. So you see this first move down here. See the downside momentum. The prices go sideways and then they fall further to this point here. You see how momentum is still red, but there is less downside momentum than the first move down, but we have a lower low. This, so whoever was asking what a divergence is, we have a move down with this level of downside momentum, then we have an equally low or lower low, and we have less downside momentum. The momentum histograms are diverging from what prices are doing. Prices are moving lower, momentum is moving higher. So therefore, it gives us a good opportunity that prices will bounce and go higher. This is a divergence. It can happen on the upside and then to the downside. Remember, when I'm looking for prices to go up, I buy Delta 70 calls. If I look for prices to go down, I buy Delta 70 puts. Okay? I see some questions coming in, so to answer any questions. Again, the reason why I don't necessarily do spreads here, if this was Apple, and it's a Wednesday, these options you run anywhere from $8 to $10. If I do a spread, I'm probably buying them for $3. The problem is I'm paying twice the amount of commissions. That's all. And if you think about it, the guy taking your order has to work the trade, work the spread. Here, it's $10. I pay $10. It's very clean and simple. I'm in, I'm out. I buy them, I sell them. Okay? So that's Google. And again, see, this is Google. This is on a 75 tick bar chart. All right, so those are basically the 3 trades. Let me back up and show you again. Fade this opening move. Just, gaps up and immediately starts to move to fill the gap. I buy calls and we move up. Okay, on this one, this gap fill trade, it's basically the same thing. It looks to fill the gap, pulls back again a little bit. Could be also like a divergence. And then it not only fills the gap, but it keeps going. Usually when we're in the room, if prices start to move this way, I watch the slope of the indicator line. And if it's still going my way and it fills the gap, I probably will sell some of the position, if not 2/3 of it. And then I'll just leave the rest on to run. Okay. Usually this is what it looks like in my trading room. All the different lines and stuff. I'll show you on the next chart. And then this is probably what we get about 50% of the time, divergences. First move, we basically, and this can also work if there's a gap here. Say we gap down to these prices. Prices pull up a little bit and then they go lower. There's a divergence in the momentum. We go long with delta 70 calls, and we just ride it until it basically peters out right here. Okay, again, by reading momentum, we can stay in the trade. All right. Sometimes, Rolando, sometimes I stay. Question is, let me see if I can answer some more questions here, and then I'll show you some stuff on this particular. Let me do this. Sorry, go back to here. All right. Bear with me. I just want to take a look at the questions. Okay, divergences. What's MQ momentum? Sid, I can answer more of those questions specifically for you. I know you have a lot of them. If you come to the early pre-trading room session, okay? Is this based on market profile theory? Naga, I honestly don't understand the question. Basically, it's a tendency that in the markets that actually close and have overnight sessions because prices are still trading pre-market and not in the cash session, and that's what creates those gaps. Plus the overabundance of orders that come in looking to be executed at the open. Do I always trade the opening move? Not always. If the market itself, if the NASDAQ is up 30, 35 points pre-market, and I need to fade a gap that if Google opens up higher and the overall market is up 35, 40 points, chances are Google's not going to come back. Okay, it's going to gap up. It may stay up. Certain aspects that I try to look for. Yeah, Rolando, your question about trading gaps in stocks. I primarily trade gaps in stocks. I may not get the level of movement. When I say I'm going to look for a gap fill, I'm basically looking to fade the opening move. I'm not necessarily always searching for the gap to fill all the way. If I'm trading indexes, that's important because I need to get that movement. If I can get Apple to move $1 or $1.50 my way, I can make more than enough money on that little scalp move. I don't need it to move $6 to fill the gap. It's great if it does, but again, that's what that is. Question are there any days of the week that are better or worse for these trades? Monday is probably the worst. I don't necessarily like to trade gap fills or these kind of trades Mondays, because lots of times what you will get on a Monday, say it closes here, it closes lower, and then Monday it'll open up here and it will just stay up here the whole day. Okay, this is Friday and this is Monday, and we just stay up the whole day. I don't get a pullback and then move up. I just stay up the entire day. That's like a gap and just doesn't do anything else. So I can't fade that. Sometimes I can't even trade that. What about Baidu? Baidu's also a good one, Joe. There's enough volume there. You just have to be a little patient. Do I always trade straight directionals? Yes, pretty much. I have been trying to buy and sell some spreads, Rolando. The one question is sometimes if I get a move like this, like see this big move here, and this is $4 to $5, if I have a spread that's at the money, well, it gets to a point where it stops earning as much. Do you know what I mean? That the difference of the spread's already covered. So whereas from here to here, I may earn 50 cents. From here to here, I may earn only 25 cents. And from here to here, I may only earn 10 cents in the spread. Okay? If I buy just straight directional calls and puts, every dollar it moves, I get 70 cents. It doesn't matter. And another thing with directional trades that are in the money, The more they move in the money, the greater their delta. So for the first dollar, I may get 70 cents to my option. The next dollar, I may get 75 cents. The next dollar, I may get 80 cents because it's moving deeper in the money. So I'm actually, because of gamma, that's another factor of options pricing. Delta is the change in the option value because of the change in the price of the underlying. Gamma is the change in the delta as prices go my way. It's basically, if you're a physics geek like me, delta is velocity, gamma is acceleration. Okay? That's the second derivative. It's the first derivative of velocity or delta. Okay. Craig, I don't necessarily look for the divergence on the squeeze, the BB squeeze. I basically use it as a filter, trying to see which direction momentum is going at that time. I know it's hard to see. It's scrunched down because it's on. I had to make it fit in the PowerPoint. Okay. What time does the pre-market session start? I think there's a pre-market session that starts about 30 minutes before the open, but there's also another market that occurs in the in middle of the night. So, but the volume is not there, Joe. But I still pay attention sometimes to some of that price action. I do look at the actual indexes because I'm looking at the futures before we start. Oh, the pre-market. That tomorrow morning, I'll probably be in the room 15 minutes early to answer some of the questions. Okay. Okay, specific questions. Do I always use a 75 tick bar chart? Remember I said I calibrate these specifically for the individual securities. Google and Amazon, I use 75 ticks. And for Apple, I use a 250 tick. But sometimes it needs to be looked at. Craig, you said Baidu and LinkedIn. Yeah, they should be pretty good to trade. I've been trading Google. I traded Apple today. I traded Netflix last week, all after earnings, and I made a lot of good trades. I am buying the weeklies that usually expire the same week. So today is Tuesday. I'm trading the weeklies that expire on Friday. I'm not worried about time decay because I'm in the trade for maybe 10 minutes. Okay, so I appreciate everybody being a little patient with that. I know this is kind of where we want to spend some time because these are the actual trades. Let me show you how I kind of combine these. Now, I know it's a little small, but bear with me, okay? I tried to get the entire hour and a half, the first entire hour in here because this is Apple. You can see it's a 250 tick bar chart. And I'll actually bring live charts on in a moment so you can see it. I'm taking up a lot of your time here. But this is what we traded in Apple. Okay, here's the gap. Here's the low. That's where we closed yesterday. And we actually gapped up this morning. And we gapped up about $6 or $7. Okay. So we have a first move higher. Okay, since we're gapping up, I'm looking to fade it, looking to trade it down. Okay, didn't really get much chance here, just let it open up, and it opened up quickly. There's a lot of trades here, and we pulled up to this point here. Now, as you can see, momentum fell, and when we went higher here, you see there's no upside momentum. There's no green bars here. Hold on. There's no green bars here. And we're hitting higher highs. So we actually bought Delta 70 puts here. See the blue line? That's our trade. So as it's falling, we were Delta 70 puts here. I sold some along the way. Had this. This is a pivot point on the daily chart. Sold some here, and then when we got close to this bottom here, we sold the remaining of our position. Then Apple proceeded to trade sideways. Okay. Now it had some trouble getting back through this resistance level at 535.82. And then when we broke lower at this point here, see it's the sideways channel, we went ahead and bought Delta 70 puts again, and we traded all the way down to here. Probably sold some right, again, selling a little bit along the way. Probably got most of it out by the time we got to this yellow yellow support level. And that's based on yesterday's high. And prices continue to go down. Now, this is the first move down here. See the downside momentum? Prices pulled back up. They went back down, made a lower low here. Do you see the downside momentum? The indicator line was diverging. So we actually bought Delta 70 calls here. It moved up and then it continued to move sideways. We did get another little push up here into this resistance level. You can see this is another divergence. I did not actually take it. This is the first high. This is the second high. Not only do we have these two resistance level, but we also have these MQ trend dots. And you can see this is the first momentum profile going higher. Here's the up momentum profile on the second high. We diverged and prices went down. I did not take this trade. We were probably trading Google or getting into something else. But we moved back up against this resistance again here. And then you can see it's like an elongated channel from above 529.70 and below this 533 level. We broke that. Momentum took us to the downside. Once we broke it, we bought Delta 70 puts, rode it all the way down to support here. Okay, probably sold some at this point here and eventually here also. We took a bounce, we went lower. Okay, that's the first low. Moved back up. Again, this is a good resistance level because we had both a pivot point and a previous day's low. Here's the second low. Now it did not go as low as the other one, but look at the histogram profile here and here and here. If you notice, this was strong downside momentum, weaker downside momentum. This is the first bullish divergence. Came down here. This is the second bullish divergence. We took the second one. We actually got in down here and we rode this all the way up. I know I got out of all my positions at the MQ trend dots here. It actually continued higher for the next 10 more minutes into this 531 level. So as you can see, all these different ways to trade in the first hour. We took this 1, 2, 3, 4, 5 trades. Okay, and each of those easily. This was a $3 move. This was about a $3 move. This was about $1.50 move. This here was $4 move, and this move here was another $4 move. Okay, buying Delta 70 calls. Delta 70 calls for each dollar is equal to $70 per contract. That's a lot of money. Okay, do I use stops or position size? Usually it's the position size, but the stops, I don't want to say my stops are loose, but my trade is defined. So if it's okay for me to stay in this trade longer as long as the divergence holds. If the divergence fails, I'm out. Okay, here's another divergence. As long as this red bar barely breaks into the red, then this divergence is still there. Okay? right here. Hold on, let me get rid of some of this paint. Okay, this high here and this high here. Well, look at that. That's a clear divergence. Now, if this green bar goes through the roof like that, the divergence goes out the window and I'm out of the trade. But just because I usually do divergences across support and resistance level. That's why we have all these. I have minimum 8 different levels here every day when I trade. I take it from the daily and I place it on these tick charts. Another way, and what I'm going to do now, I know I'm running out of time here, guys. I'm sorry. I want to quick show you on real live charts. I don't have much time to go through any more type of examples, but I also wanted to show you, bear with me here. I'm going to get rid of all my ink, and I want to show you what this looks like. This is what I trade on in the morning. I can't draw on these, but this is oh, this should be Apple. Sorry. I think I was looking at that. This is Apple, this is Google, this is Amazon. The one other thing that I do when I'm trading, if I'm looking to actually, if I see a divergence in Apple, I will actually also add, you see this is a what I call my half-size tick chart. You see this is 250 tick, this is 125 tick. So I will have 2 bars here for every 1 bar here. I'll see the divergence here. This is a good example right here. This is a low. See the downside momentum? See the second low? They're nearly equal, like a double bottom. Do you see the momentum profile here? It's much weaker to the downside. That is a bullish divergence, and prices move higher. I also, the one question was, do you use that? What do you use this squeeze for? See the divergence? Do you see how the squeeze bars are going up? The tops of the squeeze bars? That's confirming that the momentum is going in that direction. I don't necessarily want to take a divergence if the tops of the bars are going down. I use it kind of as a filter to keep me from getting into a divergence too early. Okay? But if I see this move here, you see that move here is the same 2 lows here and here. Okay? So I see the divergence here. I may wait until I get a bar like this that's higher than this previous bar. So I got a lower high, a lower high, a lower high, a lower high, a higher high. Boom, right there. Because I see the divergence, I'm just waiting for the turn. And there we go. Yeah, that BB squeeze you can get that with TradeStation, I believe. MQ Momentum Joe, that is part of the Value Charts large bundle. I'll show you guys that. So basically, that is how I trade in the first hour. Apple gave us, as you guys can see from that last chart, gave us lots of good trading opportunities today. That last chart I gave you was basically Apple today in the first hour. Again, it continued on. I actually traded Apple when it broke here too, later on in the afternoon. And then I traded this bounce.